Hey guys, Dave Keller here with Market Misbehavior, and I'm often asked about cloud charts, or what are actually called the Ichimoku cloud charts. Today I'm going to share with you what Ichimoku cloud charts actually represent, how you can use this technique to better understand a trend on a particular chart, and also focus on key areas of potential support and resistance. So today it's all about the Ichimoku cloud charts. So at times in my career, I've been able to spend time in Tokyo and in Japan, but also on some of the Japanese trading desks in the New York area. And I've found when you talk to Japanese investors, a lot of times they use a couple set of techniques that are all based in Japan or were created or discovered in Japan. Candlestick charts are one of them. So I've seen a lot of Japanese investors use candles and have talked to them about some of the strengths and weaknesses. And again, those were brought to the U.S. Decades ago by people like Steve Nissen and others who share their experiences of learning from investors in Japan. Ichimoku cloud charts are another part of this. This is a traditional Japanese technique that actually combines a number of different technical indicators onto one chart. The idea is one look at the cloud chart of the Ichimoku chart gives you a sense of the overall trend, and it is really a trending indicator, as you'll learn as we go through some examples. What we're going to do today is look at the chart of Snap and look at the cloud chart and actually talk about what it's telling us. We'll also go through the components in the Ichimoku cloud chart and talk about how they're calculated and why they're used. We'll also apply the cloud technique to the S&P 500. Before we get to all those charts, if you like this sort of thinking about investor decision making, behavior, charts, technical analysis, behavioral finance, that sort of thing is of interest, I hope you'll subscribe to my channel. It'll be awesome to have you along this ride. Also, give the video a like if you appreciated it. We'd very much appreciate that back. Finally, put the comment below. What do you think about the cloud chart on the S&P 500? Do you agree with the assessment using the cloud model today? Let's get to the charts. Okay, so here we're looking at a cloud chart. A lot of people just call this the cloud model. It is technically called the Ichimoku charts, and there's a longer name that very few in the West actually refer to. So Ichimoku or cloud charts is probably how you will hear it referred to. And you'll commonly see it in this sort of format. And different charting platforms have it in a different way, but this is the commonly used representation. And what you'll see is on the price chart, you'll see this shaded area, and it'll be like a blue shaded area. On stock charts, we do it red and green, depending on whether it is sort of in an uptrend or a downtrend. Now, one of the first things you might notice is that it's actually plotted in the future. The Ichimoku cloud chart is one of the few technical indicators that's actually plotted in the future. The what's called the leading spans, or the cloud, is actually 26 days in the future. So based on the current data, you project where this area will be 26 days out. So it's very unique from that. A lot of technical indicators are lagging or are based on charting data in the past. This is actually part of the indicators actually plotting it a little bit forward. Now we'll talk about how we use this cloud model. It's basically a classic trend following technique. Very simply, when you bring up a chart, is it above the cloud or is it below the cloud? Is it above a cloud that's going higher, and on stock charts would be green? Is it below a cloud going lower, meaning it's it's a red cloud and heading lower? Is it trading around the cloud? Is it in a congestion phase where you'll see the cloud basically almost disappear as it becomes flat, and the price kinds of ranges around there? We've talked on my Market Misbehavior channel a lot of times about charts in an accumulation phase, and the Ichimoku chart with a stock in accumulation phase would be the price above the cloud, and the cloud is in green going higher. A distribution phase, the price is going lower. It's below a downward sloping cloud in this on this platform shaded red. A consolidation phase, a sideways phase, is where you see the cloud almost disappear. You can barely see the cloud because the two spans the leading spans are almost equal, and you can see the price trading around those spans. So very quick look, you can differentiate whether the chart is an accumulation phase, distribution phase, or a consolidation phase. Now, it's also worth noting that when you're above the cloud, you often find support at the cloud. You can see that here on Snap. Here in early 2021, you broke through it a couple times here in March when it entered more of a consolidation range. But also you see it bounced off of it a number of times here in September and October of last year before the big gap below the cloud. And that's where the cloud can be really helpful. It gives you a sense of what the trend is going to be 26 days out, all right, or what the overall trajectory should be. So where we are at relative to that cloud can tell you a lot about the future prospects. Gapping below the cloud and getting through that lower boundary of the cloud is a fairly negative fairly negative pattern. So at this point, the trend is lower until you, if you reach the cloud, you'd expect resistance as you hit the cloud. When you would break through the cloud to the upside, that would be a bullish transition. See the same thing here on the opposite side. Breaking above the cloud is bullish. Pulling back, you'd expect support at the cloud. When you finally break through the cloud to the downside, that indicates more of a reversal. The fact that you gapped lower and then saw the cloud model rotate from positive to negative tells you how quickly that trend has changed. Now, this is just one piece of the Ichimoku model. It actually has 3 different technical indicators all combined into one. Here's the cloud. You can still see, and it's super busy, which is why I usually don't show these other components on here. But you can see the cloud is plotted in the future 26 days. This green line is called the lagging span. It's literally just the current price plotted 26 days in the past. You have these 2 lines, the red and the blue lines. The blue line is called the conversion line. The red line is called the baseline, and they're basically based on the ranges that the stock has been in over a period of time. On StockCharts, there's a free section of the website called Chart School, and if you search for Ichimoku clouds, you can get to this article, and it explains these 5 lines. The conversion line basically sees it's the range, the midpoint of the last 9 days, about 2 weeks. The baseline is the midpoint of the last 26 days, the high and the low over the last 26 days, right in the middle. That's where the baseline will be at any moment. So where am I at? Here we go. The red line and the blue line. The blue line is the conversion line. The red line is the baseline, using those formulas that I just showed you. The lagging span is the current price plotted 26 days in the past. Then you have the cloud, and the way the cloud is actually calculated is using the conversion line and the baseline. So it has 2 leading spans. Leading span A is basically the midpoint between the conversion line and the baseline plotted 26 days in the future. The leading span B is the midpoint for the last 52 periods or 52 days plotted 26 days in the future. And that's how you basically take the current price action. You calculate these conversion and baselines based on the recent price history, and then use those to calculate the forward-looking. So you see this green line here is the midpoint of the red and the blue line, but it's plotted 26 days in the past. That's kind of how it works. So all of that is just giving you a bunch of detail on how it's calculated. At the end of the day, the cloud model really comprises of the 2 leading spans, or what's called the cloud. And you very simply look, are we above the cloud? Are we below the cloud? Is the cloud sloping upwards? Is the cloud sloping downwards? You would often assume that price will find congestion, find support or resistance within the cloud. And when the cloud disappears, that tells you a chart is in a consolidation phase. Snap is a really interesting chart to look at today. It made a new 52-week low today. After hours, it's gapping higher on earnings. And I would certainly be looking at the cloud model here, right? Can it get above the cloud? And that would be the confirmation. Even if you gap higher, if you don't get above the cloud, it tells you based on this methodology that the trend is overall still negative until you can get through the cloud and rotate back to the upside. What is this model telling us about the S&P 500? Well, if we look back over the last 1.5, 2 years or so, you can see for the most part, we have been above a positive cloud, right? There have been a couple consolidation phases, like here, September and October of last year, where the cloud disappeared. But from there, we've been above the cloud for the most part. We've pulled back a number of times, and you can see often the price has gone into the cloud, but has rarely gone below the lower end and has bounced back to the upside. What's happened in the last month, 4 to 6 weeks or so? We rotated down through the cloud. We initially bounced out of it here in early January. We then broke below there and now have bounced up. And as of yesterday, I'm recording this on Thursday, February 3rd, after the close. On Wednesday of this week, you traded right up into the cloud, and that's after reaching the cloud yesterday. Today, we're rotating right back lower. So this is actually a fairly compelling case for the market rotating lower. The fact that it's had been above the cloud for so long, broke below it, now testing cloud resistance, and so far appearing to fail. So as long as we remain below this cloud, which is now rotating lower, the trend on the S&P 500, according to the Ichimoku cloud model, is bearish. So there we go. That is a quick primer on the Ichimoku cloud model, or what a lot of people refer to as cloud charts. I found it's a really interesting way to relate what's happening in the price and just think about a longer term trend following perspective. What's unique about the Ichimoku cloud is it's plotted in the future. So it doesn't just lag behind like moving averages and show you where the trend has been. It's actually designed to try to anticipate potential areas of support and resistance going forward. Really interesting right about now when you're in the meat of earnings seasons. You have a lot of gaps with Snap gapping higher, it appears. Facebook gapping lower after their earnings earlier this week. Amazon gapping higher, and the cloud model a lot of times can give you a sense of where some of those moves might end up. And again, identifying whether or not quickly, whether a stock is above an upward sloping cloud, below a downward sloping cloud, or if the cloud has disappeared, very quickly allows you to identify strong, weak, and sideways charts. This sort of thinking about technical analysis, investor decision-making, behavioral finance is of interest to you. I hope you'll subscribe to my channel. It'd be awesome to have you along this ride. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. What do you think about Snap and the S&P 500? Let me know in the comments. For Market Misbehavior, I'm Dave Keller. Have a good one. Talk to you again soon.